Good morning, good afternoon, good evening. Thank you for taking the time to watch this, whenever you are, wherever you are. This is the market update for November 2025. The date today is the 1st of December 2025, so we've got the whole of the month of November to look back on and analyse. Now, ultimately, we started the month in the same place as we finished, i.e. there hasn't been a huge amount of change in value from start to end of November. But the meantime, i.e. those days in between, there has been quite a lot of volatility. And this is commonly known as a kangaroo market, i.e. you don't rise or fall. So in a bear market, you would fall. In a bull market, you would rise. You stay in the same position in a kangaroo market, but you bounce up and down within a channel, like a kangaroo does. There hasn't been a huge amount to report and talk about, but ultimately we've ended the month of November at around the same valuation as we started. Now, from a 12-month perspective, the most cautious portfolio in the Zenith range has returned 6.41%. A balanced portfolio, i.e. 3 out of 5, has returned 10.55% over the last 12 months. And the most adventurous portfolio, i.e. the 5 out of 5, has returned 14.1% over the last 12 months. So let's bring this to life by putting it in real pounds and pence. If you had invested £100,000 into the Zenith cautious portfolio, either 1 out of 5, 12 months ago, you would now have £106,410 in your investment account. If you had invested £100,000 in the balanced portfolio, i.e. the 3 out of 5, you would now have £110,550 in your investment account. And finally, if you invest in the 5 out of 5 or the most adventurous portfolio, £100,000 would become £114,100 today. The reason that a 5 out of 5 portfolio has delivered, say, 14% is that you have bared a risk premium over cash. The journey you've gone on over the last 12 months has not been the smoothest. It's not gone up in a straight line. Around February time this year, markets fell and the portfolios pulled back as a result. It took around 6 months for these portfolios to recover, but since then they've grown substantially, and therefore no matter what risk profile you're in, you're probably quite happy with the returns. On a 3-year perspective, the returns are even more attractive. A 1 out of 5 portfolio over the last 3 years in the Zenith range has returned 21.02%. So £100,000 would have become £121,020 over that time period. A 3 out of 5 portfolio, a balanced portfolio, has returned 35.49% over the last 3 years, and therefore £100,000 would be £135,490. And a 5 out of 5 portfolio has returned 51.04%, and therefore £100,000 invested 3 years ago in this portfolio would be £151,040 today. So overall, the portfolios have delivered good returns, and they've done this by being invested in high quality, well-diversified assets. When you're investing in a portfolio, you are investing in business, you're investing in underlying companies. And the one thing that stocks and shares are 100% correlated with over the long term, it's not government, it's not economic policy, it's not global events, it's growing their pounds and pence, dollars and cents earnings. If a company makes more money tomorrow than it does today, then the likelihood is the share price will rise. When we extrapolate this over a time frame of decades, that is the only thing a share price is correlated with. In the most recent earnings release in Q3 of 2025, 87% of companies in the S&P 500 exceeded earning expectations. So that the largest 500 listed companies in America beat expectations at a rate of around 9 out of every 10 companies. The earnings expectations were already quite difficult to beat, i.e. the market was expecting highly of them anyway, and 9 out of 10 companies still managed to exceed that. So companies are making money, they are making profit at levels we haven't seen before. And something that has caused a lot of volatility within the markets over the last month or so has been the media talking quite readily about this circular flow of money in the AI space. And AI is going to be a hot topic over the next few years. It's going to be around, it's here to stay, and it will bring benefits, it will bring downsides. However, the most common thing that people have been talking about this month is this concept of a circular flow of money. So what is a circular flow of money and why is it relevant to the AI space? Well, typically speaking, if we just use a small scale and say there's 3 people in this scenario, person A, person B, and person C. Person A buys something from person B. Person B uses that money that they got from person A to buy something from person C. And then person C uses that money that they got from person B to buy something from person A. Now, realistically, person A's got their money back. It's passed through a couple of different hands to get there, but they've got the same money that they started out the scenario with. Now, the idea is has any value actually been exchanged in that transaction? Has any money actually been made? Well, on a very large scale with lots of different transactions, this is how a well-functioning economy simply works. But it does so on a very large number of transactions, so it takes a very long time for person A to get their money back. Ultimately, the concern in the AI space is that there are only a handful of companies operating on a huge level, and person A is getting their money back fairly quickly. And I think in this scenario, it would be fair to say that person A is Nvidia. And basically, there's a few people in the chain, but ultimately, Nvidia get their money back. And we will see whether this actually does turn into something worth looking at. At this point in time for a portfolio and the Zenith portfolios, I wouldn't spend too much time thinking about this because the portfolios are so well diversified. Even just the equity portion of the portfolio, there's over 5,000 different companies. So when you're hearing a handful of names repeated over and over, yes, you may be invested in those companies, but ultimately you've got a huge amount of diversification in other markets and other industries. So when we're talking about eggs in baskets, there's a lot of different eggs and there's a lot of different baskets. So don't get too bogged down with some of the headlines. Ultimately, these portfolios are designed to deliver long-term returns within a given risk profile. And that's exactly what they're doing and will continue to do. Now, if you have any concern about anything that's happened within the world in the last month or so, or any concern with your own financial plan, please get in touch with your financial planner. If you have any queries for the Zenith team, please feel free to send them across. Thank you very much again for taking the time to watch this video, and I look forward to seeing you again soon. If you don't mind, if you could give us a subscribe and like the video, it really helps. Thank you very much, and I'll see you soon.